95% of traders trade iron condors based on feelings. But feelings are not a strategy and will cost you thousands of dollars. I've traded hundreds of iron condors since 2018 with an 80% plus win rate. Today, I'll teach you 10 iron condor rules to help you maximize your profit. The first rule with iron condors is we have to be entering iron condors when the volatility is high. How can we check for that? We can use the IVR metric to check. IVR should be over 30, which signals elevated implied volatility relative to the past year. And this is ideal for entry conditions. The reason is because iron condors are a short vega strategy. Iron condor gains value as IV contracts after entry. Rule number 2, strike selection. We will use the 15 delta strikes for both the short put and the short call. 15 delta above the price for the short call and 15 delta below the price for the short put. At 15 delta, each short legs has about an 85% probability of expiring worthless, making this a very high probability trade. So let me show you what I mean by that. I have SPY open right here. This is the delta column for the put. I'm going to go down to the 15 delta strike. 15 delta is right here. I will choose the one with the round numbers. I don't like the numbers where it's like 686, 687. I like the increments of fives. Why? Because you can see the open interest is a lot higher on those right here. So 685 has almost 2K option interest. 690 has 7K interest. So I would choose those. Now, I have a choice between 690 and 685. Which one should I choose? They're both very close to 15 delta. In this case, I will choose the lower one. I will round down and go to the 14 delta option contract, which is 685. I'm going to open 5 with, like that. And on the call side, same thing. We're going to scroll down all the way to the 15 delta. 15 delta is right here. Now, 15 delta is 784. I don't like that number. I'm going to round it up to the nearest 5. So 785 right here. And I'm going to do 5 with. There we go. That's how we do it. Rule number 3, liquid instruments only. Some examples of highly liquid instruments that has a lot of people trading them and that has high option interest is the SPY, the QQQ, and the IWM. These are great candidates to trade if you like to play equity indexes. Now, the bond ETF TLT is also very liquid and great to trade with. GLD, the gold ETF, is another very nice and commonly traded instrument. I personally trade it all the time. Why liquidity matters. We only want to trade instruments with tight bid-ask spreads. That's the main reason. If there's bad bid-ask spread, we're going to get slippage on every entry and exit. And every time you enter with a few dollars slippage on the entry and then slippage on the exit, it's going to silently compound invisibly over dozens of trades and becomes a significant drag in larger accounts. Don't open during trends. This is an extremely important rule. When we open an iron condor into a strong directional trend, we are dramatically increasing the probability of one of your short strikes to being tested immediately. Reversals after a trend exhaustion can be sharp and fast. Wait for the pullback. Let the trend pause before entering. Context matters. Look for consolidation or mean reverting behavior. I have a picture here that I marked out all the spots where I would have entered and what is an ideal entry for iron condors. So all of these entries are during a pullback. So if we look right here, we're trending up. We're not going to be entering anytime during this trend. Now we have a strong pullback. to the 21 EMA, which is the green line. This is a perfect entry. When the stock market pulls back, the IV is also elevated, so that makes our premium more rich and our wings wider. And second, we do not want to be entering on a trend because it might continue to go up and it will breach one of our short strikes. Let's look at another example. We have a trend right here, up, and on the pullback to the 9 EMA, this is an ideal entry also. I marked a lot of various entries where it's possible. Notice how all of them are not during a trend, an uptrend. Look at this one. We have a big uptrend, up, and then we finally pull back very strongly on this red day, and we were consolidating a little bit on the 9 EMA. This is patience. We waited for many weeks until we got this entry, and after this it consolidated sideways, which is perfect. The arrow marks ideal pullback entry zones, price returning towards a moving average before re-entering range-bound behavior. 5. Diversification. Never stack correlation risk. You can only hold one active iron condor per non-correlated instrument at any time. Let me give you an example. This would be acceptable in your portfolio. An iron condor in the SPY, an iron condor in the GLD gold ETF, and an iron condor in the TLT bonds. 3 instruments with low correlation. Equity, commodities, and interest rates move independently of each other. What is not acceptable? A SPY iron condor plus a QQQ iron condor. These are highly correlated equity index. Holding both doubles your directional exposure. This is not diversification. This is essentially doubling your risk. By the way, traders, if you guys like what you're learning so far and you want to learn how I trade options for income, check out the link in the description below to get your free copy of Options for Income Playbook and also to join my newsletter. Now back to the lesson. Rule number 6, aim for the 60 days to expiration contracts. I like to choose between the 45 to 75 days contracts, with 60 days being right in the middle, so that's ideal. Now, why do I don't like contracts that are below 45 days? The reason is because the wings are narrow, delta and gamma risk is elevated, and the trade becomes sensitive and difficult to manage. The target zone is 60 days, right in the middle between 45 to 75. Wings are wider, providing a lot more room for error. Lower delta and gamma means smoother management. Anything above 75 DTE, the theta is just too slow, so I don't prefer that. So just to recap, 45 to 75 days expiration is perfect. 60 days is my personal preference, which is right in the middle. Rule number 7, position sizing. Allocate a maximum of 3% of net lick value per trade. So let me give you an example. If your account is 100,000, then your max loss should be only 3%, which is $3,000. Let's do some calculations. In this example, let's see how many iron condors we can put on. 3,000 divided by 365 risk per iron condor is 8.2. Now we always round down, so we're going to be opening 8 iron condors. Always round down when calculating contract count, never round up. Staying slightly under the limit is intentional capital discipline. I have Tasty Trade open right here. Now you can see the max loss. The max loss is 383 with a max profit of $117. Okay, we only want to have a max loss of 3,000. So let's check how many contracts we can put on. I'm going to increase to 2, 3. Keep looking at the max loss right here. We're going to click it until just we're under 3,000. Now This is over 3,064, so we have to take one less. So we can only trade 7 iron condors with a max loss of $2,681. This is how you calculate your sizing for how many iron condors to put on. Rule number 8, stop loss and profit taking. For profit taking, the rule is very simple. We're going to be exiting when the trade reaches 50% of the original credit collected. So let me give you an example. If we collected $1.20 on the entry, we're going to close it out at 60 cents debit. So we'll lock in half of the profits of 60 cents per contract. Now the stop loss rule is also very simple. It's 50% stop loss. So we'll exit the position when it has lost 1.5 times the original credit collected. Example, we collected $1.20 when we entered the iron condor. We're going to stop out at $1.80 because 1.2, $1.20 times 1.5 is $1.80. So we'll lose 60 cents when we stop out to cap the loss. Rule number 9, close at the halftime remaining. Regardless of P&L, exit the trade when half of the original days to expiration has elapsed. Time-based exit prevents you from holding on into the high gamma danger zone near expiration, where small moves can cause outsized loss. So let me give you an example here. If we entered the iron condor at 60 days to expiration, we will be exiting regardless of P&L at 30 days. Now, vice versa, if you entered the iron condor at 45 days to expiration, we're going to close the trade around 22 days to expiration, which is half. Now, just a reminder, this rule applies regardless whether the trade is profitable or not. This is a risk management rule. It's not an optional guideline. Last but not least, iron condors are to be traded independently from the rest of your portfolio. What I mean by this is the strategy is a delta neutral strategy and is not to be used to balance out other positions in your portfolio. Traders, if you follow these 10 rules, it will for sure help you maximize your profits when trading iron condors. In my opinion, iron condors is one of the most high probability strategies out there that can be used for any portfolio. It is very versatile, it is very stable. That's why it is a popular strategy for that reason. This is a very valuable trade that you can use for the rest of your life in your trading career. So learn it well, follow these rules, and trade small, trade safe.